Welcome to another epic episode of Stock Talk. My name is Amin Reina and I'm an investment coach and founder of Sage Investors. And as an investment coach, what I do is I help new and experienced investors who want to become more financially secure, but end up feeling confused and intimidated by this whole investing concept. A lot of times people don't know where to start when it comes to investing, or they've been investing for a while and just don't seem to be making enough progress in their portfolio. So what I do as an investment coach is I teach people and I engage with people on how to make more successful, educated investment decisions so that they can achieve a certain level of financial freedom in their lives and achieve that financial freedom with confidence. So this is Stock Talk. This is my little podcast slash video that I kind of put together where we talk about all things investing and where I share with you my own personal observations about what's going on in the stock market and the whole investing domain, and also share with you some of my own decision making that I do with my own investments, and with the hope that not necessarily you follow exactly what I'm doing, but that you understand a little bit about the thought process that I'm using to make investment decisions, and hopefully you can take some of that away with you and apply to your own personal investment decisions. So this is episode 77, and today it's viewer mail day. One of the things I've been doing since I've gone to this sort of more podcasty kind of format with Stock Talk is I get a better sense of what people like and what people don't like. And since I've been doing this gone more podcasty, I've seen the episodes that people really are interested in are one of the top episodes that I've done was the one I did a little while back on viewer mail, where I basically just answer investment specific questions from people out there who have sent me stuff and have asked me stuff, and I just basically share what my answers that I've shared with other people. And again, with the whole prospect that there's something here that you can take away and learn from and apply into your own investing circumstances. So again, I got a few questions here that I like to share with you that have been asked, and I thought I'd give you my take on some of them. So we'll just go through. I got my notes here. So let's just not waste any time. Let's just get down to it. Okay, so the first question I'm going to ask here, let's start with a little bit, like a shorter kind of answer, is what is the SEC 10K report? Now, in terms of investing, one of the kind of information sources that we will rely on, especially when it comes to when we're looking at investing in individual stocks, is the company's annual report. Once a year, at the end of the company's fiscal year, they'll issue with their annual report, which will summarize their financial performance of the year, talk about some of the accomplishments that the company has done throughout the year, throughout the past year. Talk about their management will talk about what they're seeing going on with the company and how the company is going to evolve. It's usually done when we're in an electronic world now. It traditionally used to be done, and you'd actually get a paper, an actual report, a document, and it was really nice glossy cover pages. It's really nice expensive paper, really slick laid out and everything, and that's really ultimately the annual report. Now, when you become a publicly traded company, you have to file reports. You have to file documents especially in the United States, with the Security and Exchange Commission. In Canada, it is the SEDAR group. They're the Canadian regulatory body where you have to disclose, provide financial information on a material basis. When important stuff happens, publicly traded companies have to disclose this information. So in the US, what companies have to file once a year is kind of with the SEC is essentially their annual report. And the way that report is called the 10K. So if you're looking for information, you see, here's the 10K report for Microsoft. What that's saying is that is the annual financial report of Microsoft. And in that report contains a lot of different kinds of information, specifically the annual financial results. So like you'll have the income statement, balance sheet, statement of cash flows, statement of changes of financial position. And you'll have a whole bunch of other types of metrics, operational kind of metrics involving the company. So that's one aspect, is the financials, and you're going to get those financials on an annualized basis. And sometimes they will also break it down by segments, so you can see how the different segments of the business, different divisions, product categories are doing. You'll get that kind of granularity in the 10K report. You may not necessarily get it in the company's annual report to the shareholders, but in the 10K report, you might get that granularity. Cool thing also you'll get in the 10K report is you'll get a real insight into the business plan of the company in terms of what is their business, what do they do, what are the components of the business, what is the management structure, how is that management structure compensated. You get a lot of great insights into the company. So if you're analyzing individual stocks, a lot of times a real good go-to place for really understanding a business is the 10K report. So a lot of times what I do is I always go to that 10K report especially when we're looking at the American companies, and also when I'm analyzing Canadian companies that are listed also, that are based up here in Canada, but are listed also, they trade in the US. They have to file a 10K report in the US too. So a lot of times you'll get some information in the 10K report that you may not get up here in Canada when they file their annual report with SEDAR. So it's a really interesting and a really good go-to reference for financial information. A lot of times that information on the annual report is also audited. There's an audit, so you can have a reasonable element of confidence that the numbers that they're presenting are pretty good, pretty solid numbers. And you get a lot more depth and granularity in terms of understanding the business, understanding the strategies. Sometimes they'll talk about strategies, that the business strategies, they'll share some of those business strategies a little bit in more depth. So it's definitely a good word read. Thing about the 10K report, it's huge. It's a huge report. It can be like hundreds of pages long. So you gotta kind of, if you want some good bedtime reading, 10K report is a great one, but it's definitely a go-to resource for those who want to analyze and are looking to invest in individual stocks and individual companies. 10K reports. When you see 10K, it's basically the annual report for the company. So that's one. So that's a question. Second question is, what are the fundamental skills for investing in stocks? Now, this is a great question, because it kind of feeds into essentially what I do as an investment coach. Is I want to help people make better investment decisions at the core of it. From my experience, the people that are really good at investing, who are really successful and make more successful investment decisions than unsuccessful investment decisions, and have ability to manage that better, they have three really core competencies, skills, what have you. The first core competency is education. They are financially literate in terms of understanding the mechanics of buying and selling stocks or ETFs or mutual funds or different types of investment products. And also they have a good literacy and an understanding of the behavioral aspects of investing, because we don't hear that a lot about. People go take courses and stuff and teach courses on investing. I teach courses on investing that talk a lot about the mechanical side, but there's also that behavior component, because a lot of times the reason that's going to separate great investors from run-of-the-mill investors is they're in touch with their emotions and they stay very disciplined. And there's all kinds of behavioral biases out there that we all have, that we all inherit, that can really cloud our judgment and impact our ability to make good investment decisions. So that's the other element. Now, when I talk about education, what I'm talking about is that you have to go out and do your MBA or get a CFA or have a PhD to be a great investor. You have to go to some high-level university or some high-level financial academic institution to become a great investor. Far from it. That's really more the industry talking to you than the realities of investing. Because one of the things I really feel strongly about, and this is just my experience, is I really believe, and as much as people will, at face level will not believe it, I think investing is intuitively simple. I think there's some basic principles you need to be aware of in terms of how companies operate, how businesses operate. And if you understand those principles and understand how to analyze companies based on leveraging these principles, you will know more than, I swear to God, 80% of the people on Wall Street. And so that's what I do as an investment coach, is I teach people. I teach people the mechanics and the behavioral sides of making investment decisions. So that's one element to it. Second competency that great investors have is they're engaged in the process. Now, even if it's somebody who's investing by themselves as a do-it-yourself investor, or somebody who has somebody else managing their money for them, common trait is they are very much hands-on. They're very much engaged in the process. They know at all times what is going on with their portfolio. They know what is going on with their money, how their money is being managed, what decisions are being made. They know, they're very on top of it. And if you've read the book, The Millionaire Next Door, that book, backed up by a lot more data behind it, talked about how engaged these next door, run-of-the-mill, unassuming people who are millionaires was that they were on top of their investments. They were on top of their money, what their money was doing constantly, religiously. So engagement is an important factor. And the reason why I also bring up engagement, why it's such an important factor is just the nature of investing. A lot of times, reason why we hate investing or really couldn't be bothered with doing investing or investing is we just simply don't practice it enough. We're not looking at companies, we're not analyzing, ETFs, we're not evaluating the markets as a whole, we're not doing any of that stuff. We're kind of just sort of with one eye looking out somewhere else and kind of making a decision by it. We look to our friends, our peer network, our support network to filter us, feed us decisions we could take. Stock tips, stuff like that. And engagement is a really important competency to have to be a good investor because there's a lot of studies that have shown, there's a book like Richard Taylor, who is kind of the godfather of behavioral economics, one of the godfathers or creators of the whole discipline of behavioral economics, behavioral finance, said once that in order to be good at something, in order to get experience in doing something, you need two components. You need to practice it, you need to practice the skill, and then you need to get immediate feedback. And so the cool thing with what people, when you bring it into investing, is we just don't practice it enough. Most people just don't practice, are not engaged in the whole act of figuring out what investments are good and how to make decisions. And then on top of that, the feedback we only get, the feedback loop a lot of times is in the form of a financial statement, which we see maybe 4 times a year. We may talk, if we're working with an advisor, how many times are we talking with an advisor? Maybe once a year, and it's usually kind of a cookie cutter conversation. Not a lot of back and forth. It's just sort of like, okay, here's how your portfolio is doing. Thanks, we'll see you in a year. There's not enough of that engagement. And the key point here is to get really good and become really experienced and really develop a skill in anything. You need to practice it. Practice makes perfect, right? Practice with investing, going through the iterative process of analyzing companies, evaluating investment products, taking action and seeing how they pan out and taking action on those things is a critical skill to have. And again, that's another element to me that separates successful investors from run-of-the-mill investors. Engagement, an important part. The third competency or third skill set that great investors have kind of is a product of education and engagement, and that's empowerment. Great investors who are educated, who have a basic literacy of how companies create wealth, how to evaluate, analyze stocks and other investment products, and are engaged constantly in that process, are much more confident. When they make investment decisions, they make them with confidence because they've done the due diligence, they've incorporated a framework, they've incorporated an investment plan and investment ideology that they stick to, that they don't let emotions get in the way of it, and they don't deviate from it. You get confidence. And when you make confidence, chances are you're gonna make better investment decisions. So competent empowerment is just another critical competency and skill set that you need to have to become a really good investor. So that's what I do as an investment coach, that's what I do. I help people develop these competencies, and ultimately the people that I work with, it's amazing as an investment coach, people that I've worked that don't have these competencies come aboard and I kind of help them out, give them a little bit of framework, that education piece, that engagement piece, because I'm in their face practicing it with them, and then also ultimately giving them the confidence that you can do this. Don't tell me what somebody on Wall Street says. You can do this. This is intuitively not hard. When you bring these elements, I've seen people who know nothing, and then I see them where they are right now. It's amazing. It's amazing. And they really, they didn't have to go through some crazy boot camp to figure it out. This takes time. It takes practice. You have to practice. You have to engage, and you have to build up your competence, your education competencies. And it's not just something you do once. You're always refining and always doing it. Like, I'm learning stuff every day. And if you read my blogs and you read my, anything I do on Twitter and stuff, you'll see I'm always constantly learning, and I'm always constantly refining how I go about making investment decisions, because things happen, things change. So hopefully that answers your question. And as I said, if you want some more information about this whole, these skill sets and what I do as a coach, you can hit me on my website, sageinvestors.ca. You can talk about my coaching program. If you're thinking of just starting, if you're just kind of that person who's just like, you know what, I need to start investing, give me a shout, and I can talk to you about some interesting programs that I'm actually developing right now, and I'm hoping to roll out in the next not too far distance for people who are looking to start investing and to get on a proper path for them to make really great investment decisions and to be successful in investing. So stay tuned for that. You can just hit me through, if you want to hit me through through my website, email me through my website. I'm more than happy to chat with you on that. So let's get down. What's the next question? Okay, here's another question I get quite a bit too, and it relates to stocks. How does investing in stocks work? Interesting question. It's such a simple, short question, but it's such a powerful question. It's just like, how does this invest? Like, stock? Like, what is this? What's this all about? I know I need to do it, but how do I wrap my head around stocks? Like, stock market? Like, what's going on here? Stocks go up. Apple went up. What do I do? How does this all kind of fall into place? How do I figure this stuff out? So I'm going to give you, because essentially I teach a course on this, and it's called about principles. It's the first module in my Everyday Investing series. It's called Principles of Capitalism and Investing. It kind of gives you that underlying framework of how companies come to be, and how companies use stocks, and how stocks play a role in a business. So what I'm going to do is I'm kind of going to give you a really condensed version of it, and kind of give you the key elements of it. And if you're interested, I really recommend you sign up for the course, for the whole program, the Everyday Investing program, because this is what you're going to learn. You're going to learn this in a lot more detail, and you're going to practice it, and you're going to be pretty freaking confident implementing it after you're done with this course. So I'll give you the Coles Notes, and let me just give you the Coles Notes version of how investing in stocks works. So to understand investing, to figure out how investing works, what investing is all about, you really got to understand how companies, because when you buy stocks are pieces of paper that ultimately represent ownership in a company, and they also represent an entitlement to the future profits that a company can generate. It's a piece of paper, but behind it, stocks are companies and their people and their ideas. And so to understand whether a stock is worth buying, or a decision whether you want to sell a stock, you got to understand a little bit about how the business works, and not like go get an MBA to figure out how a business works. Just understand some principles. So the key thing you got to understand here is every business, doesn't matter if it's an Amazon, or it's a Google, or it's Freeport McMoran, or if it's TELUS, they all operate under the same premise, is that in order for these businesses to survive, they need capital. In order for companies to sell products and services to us, they need capital. And capital usually comes in different forms. It could be, you need people, so you need labor. You need equipment maybe to produce your product or service. And those are kind of your big ones. And you need equipment. You need a factory, to build this place. You just don't build a factory, unless you're selling a lemonade stand in the summer. You're going to need a building to do that. You need capital, and to pay for these things, you need money. So money, the purest form of capital is cash, and so cash is really the lifeblood of a business. So any company out there, in order to sustain itself, to be viable, to exist, needs cash. So when you're starting a business, or you're a company, been around forever, how do you get cash? How do you raise money? How do you finance your business? Well, I'm going to keep it very simple. There's two ways you can finance your business. You can go to a bank and borrow money and say, hey, I got a really great business. It's generating a lot of money. It can generate a lot of profits. Can you lend me some money so I can, buy a factory, or buy some cars, or hire some more people? And you give a business case, and they lend you money. And the point of it is, they lend you money, you pay them back, but you pay them back a little extra, which is called interest. That's one way you can raise money. The second way you can raise money is by selling parts, or if not all, a good chunk of the ownership of your business. And also the entitlement to any profits that are done. And that's done the traditional way is by issuing stocks, and stocks represent that ownership. So what a company will do if they decide, okay, I'm willing to sell part of my business, part of my control of my business, and future profits in a part of my business, a percentage of that future profits, is they'll go to somebody like an investment banker. And then what they'll do is they'll kind of design a mechanism for them. They will go out and essentially raise that money. So if I need $1 million to run my business and I'm willing to sell $1 million, they will go out and sell, and they'll do all the math and everything like that and figure it all out. They'll go out there and issue stock and go out there and try to find people who will invest in your business, and they'll take a cut and take a fee in it, and they will issue stock to represent that ownership in that business. And that's usually that mechanism with the investment bank to raise money is called an IPO, that initial public offering. So they go out and find people who will willing to invest in your company. And so ultimately, after the people receive those shares, they can either hold on to it or they can go sell it. And that's where they're going to go to the stock market. So that stuff you see on CNBC with the trading floor and all these people like throwing paper in and stuff like that and computers and everything like that, that's that stock market we know. But there's actually a more fancier name for that. It's called a secondary market. And that's where stocks, after they've been issued to by the company through the investment bank, they trade in the secondary market stocks. And so ultimately their price is determined by all different kinds of factors. There's supply and demand. If there's a lot of stock out there and there's a lot of demand for it, stock price will go up and adjust accordingly. So part of it is a supply-demand equation. But a lot of it though, when people are figuring out whether they want to buy or sell that stock, comes down to analyzing the business. And when you analyze a business, when you're looking at a stock that you want to buy, you got to look at it from a couple of different perspectives. You're basically trying to evaluate specifically the management of that company that's running that business, that's managing that scarce capital, to see if they're doing a good job at it. So how can we figure out as investors if they're doing a good job? Well, we can ask some questions. And there's really three core questions we can ask. First of all, we can ask the management. We can figure out management's ability. First is, do they demonstrate an ability to raise money? Can they go and, if they need money to run the business, can they go out and get the money that they need to run the business? Can they set up the company in a way that can generate cash flow and bring in cash flow so that they can invest in the business and develop new products and services and do that efficiently and do that? So we want to look at management's ability to raise, to finance the business. Good management, good companies have really strong management that can do that. Second thing we want to do is to see what after they've raised all this money, either through stocks or going to the bank and borrowing money, what are they invested in? What do? They just leave it in the bank and collect dust on it and collect interest? Or what are they investing in? What kind of products and services are they developing? Is there a demand for those products and services? Are people buying that products and services of that company? So we want to look at their ability to look at the market and identify opportunities where they can bring in more cash flow. So that's the second element we want to look at. And the third element is really the operational profitability side. Are they bringing in more money than they're spending? Because if they're creating profit, it means you're creating value. There's extra value in the company is increasing. And if the value of the company is increasing, then chances are the stock price. People are going to want to own a business where the company is being able to generate profits, generate cash, because that means that company becomes more self-sustaining. And that's a company you want to buy, because then if it's going to be more self-sustaining, then it's going to be in business long enough. And ultimately, as a shareholder, you want the company to be in business long enough so you can get access to those profits. And ultimately, people want to buy stocks that represent companies that are creating value, that are creating profits, that are creating tangible wealth for the shareholders. So when you ask these three questions, this gives you a framework of determining whether you want to buy a stock or sell a stock. Because if management is not doing any of these three things, then chances are you're not going to buy that stock. Or if you're a shareholder and you're saying management isn't, they're selling products that nobody wants, they're having a hard time, raising cash, and they're not profitable. Why am I holding this stock? And that's when you would sell the stock. So those are the elements. And again, this is, I'm giving you this like literally a Coles Notes version of my first module on investing. I go into a lot more depth, and I use a lot more tangible kind of examples. We walk through an example in my everyday investing course that shows you these elements and shows you how to build this framework. Because when you're making investment decisions, this is what it is. It's like riding a bike. Every company you're going to analyze, every stock you're going to analyze, you're going to be asking the same questions over and over again. And sometimes it might become really boring and very redundant and very repetitive, but that's investing. It's literally kind of like getting in the hamster wheel and just keep going, going on a treadmill, keep going, answering the same questions, getting the answers, determining if it makes sense and worth buying or selling, and you just keep going. So just wanted to share with you, I thought it was a really good question because it sounds so simple. How does investing in stocks work? But it's simple. It's a very beautiful, elegant question. But you can see the mechanics, the intricacies of figuring out at a high level are not that hard. But you can see there's kind of a lot of moving parts going on here, and that's what I kind of teach people in my course, is how to figure out those moving parts and how they all work together. And it's really cool. It's something I really love to do. And so if you're interested in learning about my everyday investing course, you can go to my website, sageinvestors.ca, and there's a section here on courses. You can see all the different courses that I offer on the everyday investing course, and also the ETF course if you're interested in investing in ETFs. Different mindset, different thought process, but there's a lot of nuggets that kind of cross over from that perspective. So that's all I got for you. I thought that's probably good. I thought that'd be good enough for today. I'll definitely be doing some more of these episodes down the road because I've just the feedback that I'm getting and just looking at the traffic. This is stuff people are really interested in, so asking questions. So if you have a question about something, about anything investing, about something you're doing or anything, and feel free to shout, send me an email. You can go to my Twitter account, at Sage Investors is my handle, and you can just direct message me. I'd be more than happy to talk to you about anything you're looking at here in terms of investing, but also talk about some coaching or any of the courses that I offer and the services that I offer that I feel really strongly can help you achieve that level of making better investment decisions and also achieving that level of financial security that all of us are looking for. So that's that. Before I head off, just another announcement for those about my webinar. As I said, I like to do, doing this year, trying to do some webinars this year on different types of investing topics. I've already done a couple this year. I originally scheduled, my next one was going to be scheduled for May 25th at noon, talking about how to demystifying ETFs, all things about ETFs. Unfortunately, because of a family commitment, I had to reschedule it. So now the new date is now June 1st, 2017 at 12 noon Eastern time. It's just for an hour. It's like a lunchtime thing. And I'm really excited about it because we're hearing so much about ETFs out there, how they're kind of like disrupting the whole investing industry, and how we're seeing really almost an epic shift now from people going away from the traditional mutual funds owning individual stocks into ETF kind of products, investments. So a lot of people want to know, what the hell does this mean? So in this webinar, I'm going to kind of give you a quick overview of what ETFs are, how they work, what's good about them. There's some, they can be really great products, but also what's important, things we need to look out for. Because a lot of times what I read out there talks about the good stuff about ETFs. There's some issues that are also out there, and you need to be aware of them. And so I'm going to share with you some of those things that you need to have in the back of your mind when you're kind of evaluating these things. I want to talk about different criteria that you can use to evaluate ETFs. And the part I'm really excited about is the case study, where I'm going to share with you my own personal decision that I had to make just recently on an ETF that a type of ETF I was looking to add to my portfolio, and sort of my thought process, the process I went through to evaluate a bunch of ETFs to figure out which was the one that would work for my portfolio and I think would be more effective and perform well in my portfolio and help me make money. So I'm going to share that with you in this webinar. So if you're really interested, all you got to do is go to my website, sageinvestors.ca. There's a link there to the webinar. Just go in there. I just need, just drop your name, email, boom, you're in. I'm going to send you a confirm as well as the coordinates to log into the webinar, and then we're off to the races. Just a quick reminder also, I have limited space in for the webinar, so the sooner you can get in, register, the sooner you can secure yourself a virtual seat for the webinar. Really love to have you aboard, really love to share some stuff with you. Again, it's on June 1st at 12 noon Eastern Daylight Time. Probably going to be, Daylight Savings Time. Eastern Daylight Time, 12 noon Eastern Daylight Time. Mark it on your calendar. Demystifying ETFs. Love to hear it, love to see you, and love to share some stuff with you about ETFs. So that's all I got for you this week. Hope you're having a good week. Hope you're making some great investment decisions. My name again, thanks for listening to Stock Talk. My name is Amin Reina again from Sage Investors. Thank you for watching, especially the new folks who have just jumped on into the podcast. Welcome, welcome, welcome. Please stick around, please subscribe. Love to hear from you, and it's all good. So have a great week, and take care, and cheers.